Hey folks, Canadian real estate investment trusts. That is what we are talking about. Is I wanted to kind of challenge myself by structuring the question as if I was starting today and I wanted some of that monthly cash flow that I could reinvest, but also get capital growth. Where would I look within the Canadian real estate market? And I have found 4 REITs that not only offer incredible growth, but incredible starting yields, some of which are well over 5%. But if you are new to the real estate market or you're new to REITs in general, and how do I find these? Well, I don't go into the small caps because I want long-term stability. So what I do is I go into the big ETFs, the big guys where the retirees go for pure security. And I found an ETF here called XRE, which is the ticker on the TSX. It's called iShares S&P TSX Capped REIT Index ETF. Now, this ETF only offers a starting yield of like 2%. And when it comes to real estate, I would much rather handpick and kind of build my own portfolio. And that's what I've gone ahead and done. Is I kind of went through all of these. And many of you know I hold RioCan. Canadian Apartment Properties is always at the top because it's highly leveraged in residential, which has been very fruitful for anybody in the residential market over the last 10 years. But that is not necessarily where the growth is coming from right now. So let's kick it off by some of the highest yielding within this list that I'm kind of intrigued by even right now. First one being Choice Properties Real Estate Investment Trust. This sucker hit all-time highs this year coming out of the pandemic in its history. So great performance from a chart perspective. And it starts with a 5% yield, which is incredible. You put 100K in here, your cash flow in $5,000 annually, paid monthly. Couldn't ask for it much better than that. Now, I could go up and down these properties, talk about how they're expanding into residential. Most of these kind of mall encored REITs like RioCan are largely diversifying into residential as their next growth vector. But I want to ask myself, are the clients secure? The things that matter most behind these REITs. And when we take a look at their top 10 tenants, guys, with Canadian Tire, TJX, Dollarama, these aren't like the most appealing, but when we take a look here at the very top of the list is Loblaws, making up 55% of their total tenant basis. Now, that is a largely leveraged tenant, and usually that would scare me. Usually I don't want tenants that large, but when we're talking about Loblaws in particular, guys, not a stock that has been doing poorly. And considering Loblaws only offers a 1.61% yield, you can get incredible exposure to this company and cash flow a much greater yield. And how has this been working for them overall? Well, unfortunately, since kind of coming through the pandemic, we can see that their tenant rental income has dropped to about 96.9% from typically an average of 98 to 99%. So this is kind of a little off-putting to me, but the fact that we're hovering above a 95% rental income base, especially getting through the pandemic, really good signs. Now, in tandem to this, we could also talk about smart centers paying a way higher yield than RioCan, probably one of those similar to RioCan in my humble opinion here. Paying a 6% starting yield has not fully recovered since the pandemic, but let's ask ourselves, is it worth buying even though it's not one of the perhaps the best performers? And when we take a look in here, guys, we can see Walmart, Loblaws, Shoppers Drug Mart, like the 60% tenant basis of this company, I really thoroughly love over, say, Choice Properties, because you're getting McDonald's, LCBO, the banks like Metro, a lot of food exposure, but probably a little more diversified. And just taking a look at how that's worked out for them, we can see that they're actually getting hit a little harder than Choice Properties because in July, they dropped down to about a 94.4% occupancy rating. But keep in mind, this is based month over month. It doesn't annualize it like we saw with Choice Properties. So this probably isn't the most accurate because if you combine all this together over 2021, it's probably closer to about 95% would be my guess, as mentioned above here. Probably why the stock is hindering a little bit of performance, but this one, like Choice Properties and like RioCan, is largely leveraging into the residential market into their coming future and largely being encored by Walmart. How has that worked out for them? Pretty incredible, right? Walmart is an encore tenant, has offered them some incredible stability through the pandemic. Because even though I think, smart centers, Choice Properties, RioCan are incredible REITs, and I kind of focused on these ones in the video because the starting yields are much higher, yield doesn't always matter. And I think when you're building a portfolio, total returns will always come into play. So you want to make sure you're buying more than just high yielders. You want to buy some that can take that portfolio into some growth projection. And where do I look for that? Well, right now it is logistics and warehousing. And there's 2 companies I want to talk about here because this one's actually at the top weighting of this ETF here. We can see it's actually the 3rd top weighting is Granite Real Estate Investment Trust. One I have recently been buying with a 3.21% starting yield. Yes, not nearly as an incredible incredibly high yield, but my goodness, look at the year-to-date growth on this sucker. It is up 21%. In the last 5 years, it is up 130%. That is not including the dividend return. Now, this sucker, largely encored by Magna, kept me away from it for a very long time. Because I'm trying to stick within the Canadian borders, I would prefer to buy Stag. Stag Industrial is very similar to Granite, but much more diversified. Their largest tenant doesn't make up more than 3 or 4%. Whereas with this guy, we can see Magna makes up 34%. And I know logistics and warehousing, probably not the most entertaining thing to think about in the real estate market, but the reality is this has been one of the most explosive markets because of e-commerce, which comes as no surprise as their tenant basis in Amazon is growing. Amazon can't keep up with their own logistics and warehousing. Many of these companies can't. Everything is moving online, so they need assistance, which is where Granite comes into play. But let's talk about Magna. If we're leveraging 1/3 of our entire investment in Magna, is that a good idea? And honestly, for a while, I was a little hesitant on Magna, but now I know some insiders, not that they're really giving me any inside information, but I do understand what they're doing with the company, and I see some resiliency in Magna being a large distributor for auto parts and all kinds of stuff, really diversifying into many different sectors, and it has actually been performing very well coming out of the pandemic. Actually, the stock's been hitting all-time highs, which makes me feel pretty good leading into this company, as if though we were leading into Loblaws or Walmart. Now, on the other spectrum with the industrial sector, we also got Dream Industrial Real Estate Investment Trust. This is one you guys have mentioned to me a lot, which also sits kind of toward the lower weighting of this real estate investment trust. And there is some other ones in here, but I want to focus on this one because I like it the most, with the starting yield of 4.21%, up 114% over 5 years. In year to date, trading up about 30%. Again, not including that dividend yield, which is absolutely staggering. And if we take a look at this one, because I could find the tenant basis, their tenant basis in Q2 of 2021 was 99.2% of tenants were paying the rental bills. Crazy good in the industrial sector, right? But when we take a look at the tenant basis on this one, where I get turned off is not understanding these companies in particular. Now, this one's got some really good global diversification, highly exposed to Canada, whereas Granite is largely exposed foreign abroad, really in the US, not as much in Canada. But these, I don't know these companies. I really don't know many of these companies, but a lot of them, if we take a look at the diversification, because again, their largest tenant makes up 3.7%, way better diversified, but we can see a lot of it's in logistics, food and beverage, consumer goods, diversified industries, residential, auto, paper, printing and packaging, and other. So, I mean, you kind of got to feel comfortable maybe digging down into the tenant basis here, but I don't understand any of these companies, so I'd have to dig into this. Just dig into it, take your time with it, look at these tenants, make sure you're comfortable with them. And again, it's not a big deal because the largest is at 3%, so you're not nearly as leveraging into something like a Magna, where the whole company's future for the time being, while they continue to expand, is largely hinged on one or two of these companies, right? But these are the 4 stocks that I'm finding really intriguing if I were to start from scratch. And I know a lot of you are saying, well, where's RioCan? Well, RioCan is something that I will potentially be talking about when the earnings season comes up, because that one is still pooping out dividends for me, and I absolutely love it. But I'm hoping that I gave you kind of a really good base starter kit for somebody looking to get a really healthy yield. Because if you kind of diversify these in a way where maybe like 60% of the portfolio is these larger paying REITs, and then you leverage like 30 to 40% of the portfolio into growth, you can really easily capture a good 4.5-5% starting yield by leveraging that over 5 to 6% yield with some of those lower 3 to 4% yields. You can almost balance it out, and not only will you be getting an incredible growth rate, really outperforming the TSX. All of these companies have outperformed the TSX, but you'll also be getting a yield that for some of these do not grow, but in Granite and Dream Industrial's case, they have been growing that dividend. Those total returns, I think, are always the most prevalent, but when you want that cash flow today, why not get the best of both worlds? But at this point, I pass the question off to you. What do you guys think about these REITs? What ones are you intrigued by? I'd love to hear about it. So stay cool, stay awesome, and I look forward to catching you tomorrow